Hello, my name is Amine, and I'm proud to present you my work for the UBS HOLT Challenge, focusing on two major healthcare companies, GoodRx and Teladoc. The healthcare technology market is expanding rapidly, driven by AI, Internet of Things integration, personalized medicine, and virtual care solutions. The market is expected to triple and reach 3.8 trillion USD in 2032, with a 12.4 CAGR supported by demographic changes, chronic disease prevalence, and technological innovation. GoodRx operates a digital platform for medication, price comparison, discount coupons, telemedicine services via GoodRx Care, and pharma-sponsored programs. The company now faces slower growth after the pandemic, stronger competition, and regulatory scrutiny, but retains strong brand recognition, a sticky user base, and a high historical margins. Teladoc leads in telehealth with services across primary care, mental health, and chronic disease management. However, Teladoc suffers from post-pandemic demand normalization, costly M&A mistakes like Leave On Go, persistent economic losses, and intensified competition. The 53% CFRI spike before the IPO reflected the hype, not sustainable performance. Since IPO, GoodRx has delivered minimal value creation, facing market saturation, pricing pressure, and competition. Margins are declining but remain stronger than peers. Investor confidence dropped as growth and profitability slowed. Despite challenges, GoodRx show better margin stability, operational resilience as a clearer value path compared to Teladoc. For Teladoc, we can see that they are consistently failing to generate returns above its cost of capital. This shows that investment have destroyed value rather than created it. And we can also see that Teladoc has heavily expanded its asset base through M&A and tech build-out, but now it's clearly pulling back, likely preserving cash, facing impairment. For the risks and leverage, both companies have enough cash to cover their fixed charge thanks to their poor fixed charge demanding structure. As for the probability of default, Teladoc is widely riskier than GoodRx, which have a probability of default below than the market. For GoodRx, we forecast gradual sales recovery to reach 6%, driven by GoodRx Care, Gold subscriptions, and B2B expansion. EBITDA margins are set to rise to plus 27%, with asset turns improving from 0.50 to 0.60. The CFRI should climb to 12.9%, reflecting enhanced operational efficiency. GoodRx valuation implies a plus 17 upside. For Teladoc, we forecast sales recovery to plus 5% by 2029, EBITDA margin improving from 6.5% to 9%, and asset turns increasing to 1. CFRI should recover to 8%, but real asset growth remains under pressure, reflecting necessary restructuring. Even in the flex scenario, Teladoc still shows a minus 32% downside, confirming its structural weaknesses. Lastly, our investment choice is going to be GoodRx. Due to their strong financial outlook, GoodRx is showing consistent improvement in CFRI, EBITDA margins, and asset efficiency, indicated discipline, capital use, and operational strength. And they have also a lower risk profile. GoodRx has low probability of default, well below the sector average, in contrast to Teladoc elevated risk. And we chose not to invest in Teladoc due to its consistent value destruction. They have failed to generate returns above its cost of capital, signaling inefficient use of investor capital. And also, they are having management instability. The company is currently led by an interim CEO, reflecting poor leadership stability and weak strategic path, which increases the execution risk.